So let's look at the four options, the four different approaches we have for our non-cash deductions. And to make it simple, we'll focus on depreciation, which again is the most common form of non-cash and where you will see the vast majority of opportunities. Straight line, which is the example we talked about earlier, is the most common way to depreciate an asset. We pay $150,000 for the asset. We decide to use straight line depreciation, which means the same amount in every year. We take the acquisition cost, or the amount that we paid for the asset. We divide it by the number of years accounting says is the useful life. So again, our example was $150,000 asset with a 15-year useful life. We divide $150,000 by 15, we come up with $10,000. That means each year we know in advance that there's going to be a $10,000 expense on the income statement each year for the 15 years. On the balance sheet, that will accumulate. And at the end of the useful life, according to accounting, that $150,000 asset will be reduced to zero for accounting purposes. Now, what we actually do with that, we'll talk about later. We have several options. This is by far the most common form of approach to our non-cash deductions, straight line depreciation. Second most common method is what's called sum of the year's digits. Now, this gets just a little more mathematical. This is where we look at an asset. We'll go back to our example where we have $150,000 invested in the asset. It has a 15-year useful life. Well, if we add up the numbers in sequence, 1 through 15, come up with a total, and then reverse them, we'll basically find that we're going to take in the very first year a quantity of expense greater than straight line, but not that much. So it'll be 7/15, 8/15, 10/15. Each year after the first year, we'll take a little bit less in depreciation expense. The reason that an organization might take sum of the year's digits approach instead of straight line is because we want a larger portion of that depreciation in the very first period. And the reason many people do this is they say that money's worth more today than tomorrow, so I'd rather have more expense today and less tomorrow. But we need to be very clear here. We never take more than 100% of what we invest in the asset. So if we're going to use sum of the year's digits, that means we're going to take more depreciation at the beginning than we would in a straight line. But as we approach the end, each year will take less. And in the later years, we'll take significantly less than the equivalent straight line 10,000. Total amount of depreciation in all of these methods is exactly the same. We're only talking about timing. How much we'll take when. It'll always add up to the same 150 total. The most aggressive method is called double declining balance. Double declining, as you may imagine, says let's start off by taking 2 times the straight line amount. So if you remember, straight line was 10,000. Under double declining, we'll start with 20,000 in the first year. That only leaves us 130 over the next 14 years. So in year 2, we'll take a little bit less. And again, this is on a simple formula basis. And it will decline, so in the very final couple of years, there's very little depreciation left to take. Why would we choose this? Again, cash today for many organizations has more value than cash tomorrow. So every organization makes the decision which depreciation method they want to use based primarily on their need for cash today versus tomorrow. Straight line is the most common and the most conservative. Sum of the year's digits is more aggressive. Double declining is the most aggressive. So these are your primary choices. Now, we haven't forgotten about units of production. Units of production, or what's referred to as UOP, is only used when we have an asset whose useful life is not measured by time, it's measured by usage. An aircraft engine has only a certain number of hours flight. An injection mold only has a certain number of uses before it must be replaced. Units of production is what's also used to calculate depletion. If you remember, we talked about having a certain number of cubic feet of gas in a reserve. Whether we extract 100, 1,000, or 6,914 units in this period, this is the method we use. We take the total asset investment cost divided by the number of units we expect to extract. That gives us our per unit value. We multiply that times the number of units we extract. That gives us the expense on the income statement in this year, and now what gets accumulated on the balance sheet over time. Again, all four methods will take the accounting value of the asset to zero over its useful life. The question is, which one do we want to use on a given asset because it's most appropriate? So that finishes for now with the income statement. Now let's look at the third of our three financial statements, which is our statement of cash flows, or the cash flow statement. It goes by a couple of names. Once again, it's broken into three components. What is critical here, as compared to the income statement is focused on the accrual method of accounting. If you remember, as we incur obligations, we record them. As we have sales, we record them. So on the income statement, we could have revenue that we've yet to turn into cash. We could have expenses that we've not yet paid. The cash flow statement is focused on cash going in and cash going out, both directly and indirectly. And here's a link between the cash flow statement and the income statement. If you remember the bottom line on the income statement, before the cash dividends, what's called the bottom line is our net income. So that ended the income statement. Well, here's the link or the bridge over to the cash flow statement. The statement of cash flow starts with that net income. How much net income did the organization create? Were there any non-cash deductions? If there were, that's cash available. So let's stop. If it's an expense on the income statement, how could it create cash? Well, remember the category. Remember the definitions. Non-cash deductions are those expenses on the income statement that we did not really spend cash on. We didn't spend that money this year. Go back to our example of our piece of equipment. We acquired that piece of equipment 3 years ago. That's when we actually paid for it, whether we took out a loan or used our own cash reserves. That's unimportant today. We're still getting to take a $10,000 expense in this period, but we didn't spend that cash this year. So for accounting purposes, we get to use that expense, that depreciation, to reduce our income, to reduce the tax. But since we didn't really spend that cash, it's still available to us. So that's why we get to add it into the net income to start our cash flow statement. Then we have 3 sections of our cash flow statement. And remember, we're giving you a very abbreviated version of a cash flow statement here. There are many examples of companies that have dozens or hundreds of lines of specific detail in their balance sheet, income statement, and cash flow statement. That's by industry custom or by what they wanted to share. It's not a requirement of accounting. So the three areas, the three sections we have on the cash flow statement start with operations. And this is the most important of the three when we're trying to understand what's going on with an organization. Operations refers to what we do. It's our main business. So this will be collecting receivables, paying payables, increasing or decreasing inventory, etc. What are the elements that either create cash, that's an inflow, that's a source of cash, or use up cash, that's an outflow. So we look at all those detailed activities and we'll net out a number for operations. Now, if you're ever looking at an organization and you want to see if they're doing well or not, if you look at the cash flow statement, which is a very important element, you want to see, is cash from operations positive or negative? That's the first step. If cash from operations is positive, that's what you want to see. If cash from operations is larger than the other two areas, that also is what you want to see. That tells you that the organization is creating most of its cash from its main business. That's a good sign. The second element of the cash flow statement is the investing section. And we want to be very clear here when we talk about investing on the cash flow statement. Investing here specifically means investing in our own long-term growth. This is cash used to acquire long-term assets, buildings, patents, aircraft, any of the long-term assets that we're using in our business. Most years, if the organization is growing, this will show a use of cash, which will be seen with a minus sign or a negative in front of it. When it comes to cash flow, positive and negative signs don't mean good and bad. Positive means an inflow, negative means an outflow. Well, if we're a stable, growing company, we want to see investing in our growth. So this section in most years, for most companies, will show an outflow. We're investing money in acquiring assets more than selling off our assets. The third section is our financing section. This refers to new debt that we're acquiring, that's a source of cash. Old debt we're paying off, that's a use of cash. New sale of stocks, that's a source of cash. Paying out cash dividends, that's a use of cash. Some years we will be generating more cash in financing, some years we'll be using more cash in financing. It just gives us the breakdown and the detail. So if we look at our three areas, operations, which is our main business, investing, which is our long-term assets, and financing, which is debt and equity, each of those has a subtotal. When we add those three subtotals together, it'll give us the net cash created or used. We'll compare that and add it to the beginning cash from the last balance sheet to give us the ending cash, which links to the following balance sheet. So here's an example where we started with the net income from the income statement to begin this cash flow statement. As we end the cash flow statement, you can see how it is linked to the previous balance sheet and the next balance sheet. That's why we said early on that the financial statements are all linked. As you can see now, each tells a different story looking at the organization. Each has a different purpose, but the only way we really can know how well an organization is doing, or perhaps what some of their challenges are, is to look at all three together and to follow the links between them.